Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're diving into some significant developments in the Canadian bond market and what they might mean for the Bank of Canada's upcoming policy decisions. Observers are closely watching the bond market, which is now pricing in a 75% chance of a 50 basis point cut by the Bank of Canada after a weak jobs report. This comes as Canada's unemployment rate saw an unexpected rise, climbing to 6.8% in November. This is the highest it's been in nearly 8 years, excluding the pandemic years of 2020 and 2021. The latest figures from Statistics Canada indicate that the unemployment rate rose by 0.3 percentage points from October, and it was 0.2 percentage points higher than what was expected. According to Douglas Porter, the chief economist at BMO, this rise in unemployment is a key indicator that might stress Bank of Canada officials. In light of this, BMO has adjusted its forecast to anticipate a 50 basis point cut at the upcoming Bank of Canada meeting, scheduled for December 11th. Oxford Economics shares this sentiment, suggesting that with slack in the labor market, soft GDP growth, and inflation at the 2% target, the Bank of Canada is likely to proceed with the rate cut. The bond market's anticipation of a rate cut is largely based on these economic indicators. If the Bank of Canada follows through with the expected cut, it would bring the policy rate down to 3.25%, its lowest since September 2022. This could result in a prime rate of 5.45%, which would lower interest costs for those holding variable rate mortgages and personal or home equity lines of credit. However, there are differing opinions on the potential rate cut. Douglas Porter also noted reasons for a more cautious approach, such as the revival of domestic demand, a recent uptick in core inflation, and the Federal Reserve's cautious stance. Desjardins, for instance, maintains its prediction for a smaller 25 basis point cut, arguing that the rise in unemployment overshadows underlying economic strength, as evidenced by hiring gains in November and other economic indicators. In November, the Canadian economy added 50,000 net new jobs, with significant gains in sectors like wholesale and retail trade, construction, professional services, education, and accommodation and food services. However, these gains were not enough to keep up with the labor force's growth, as 138,000 people were actively seeking work. This surge in job seekers marks the fastest pace outside of the pandemic years. James Orlando from TD Economics highlighted that while the unemployment rate increased, it was due to a significant rise in the labor force rather than job losses. Regionally, Alberta, Quebec, and Manitoba saw the most job gains, while other provinces remained relatively stable. Other noteworthy points from the employment report include a rise in youth unemployment, a slight increase in long-term unemployment, and a year-over-year growth in average hourly wages. The unemployment rate in Canada took an unexpected turn in November, rising to 6.8% from 6.5% the previous month, according to a recent report from Statistics Canada. This jump marks the highest rate of unemployment since January 2017, if we exclude the pandemic years. Despite a robust hiring month, where 5,050 jobs were added, double what analysts had anticipated, the increase in job seekers outpaced these gains, pushing the unemployment rate higher. The details of the hiring report reveal a concentration of new positions in the public sector, which saw a net increase of 45,000 jobs. This surge in public sector employment contrasts with the private sector, which experienced only a modest rise in jobs. Bond yields in Canada fell following the release of these employment figures, as did the Canadian dollar, which dropped below 71 United States cents. Investors are now anticipating a potential interest rate cut by the Bank of Canada, with a half-point reduction expected on December 11th. This would be a continuation of the easing trend observed in late October. The probability of such a cut has increased to 75%, up from a 50-50 chance before the employment data was released, according to Bloomberg data. Doug Porter, chief economist at the Bank of Montreal, commented that the high unemployment rate provides the Bank of Canada with a clear incentive to ease monetary policy. However, he also warned of potential downsides, such as further weakening of the Canadian dollar and the possibility of reigniting the housing market. Despite these concerns, Porter adjusted his forecast to a 50 basis point cut, aligning with the market's expectations. There are still analysts on Bay Street who believe the Bank of Canada might opt for a more conservative approach with a quarter-point cut. They cite the revival of domestic demand, a weak Canadian dollar, and limited room for U.S. rate reductions as factors that could influence a less aggressive rate cut. The United States economy, in contrast, added 227,000 jobs in November, showing resilience despite previous disruptions. The Statistics Canada report also highlighted that the labor market's growth was primarily in full-time positions, and public sector employment has grown by 2.9% over the past year, driven mainly by healthcare. In comparison, the private sector grew by 1.3%. Average hourly wages increased by 4.1% year over year in November, although this was a slowdown from 4.9% in October. James Orlando, a senior economist at Toronto Dominion Bank, remarked that despite the complexities of the current employment report, the labor market remains on solid foundations. The number of unemployed individuals rose by 87,000 in November, bringing the total to 1.5 million, an increase of 22% over the past year. This rise in unemployment highlights the challenges the economy faces, even as it continues to add jobs. Bank of Canada officials have been vocal about the need for increased economic activity and hiring, particularly as inflation has been hovering around the central bank's 2% target. With the Canadian economy sensitive to interest rates due to high household debt levels, the potential for a rate cut is seen as a necessary step to support economic growth. Meanwhile, the United States Federal Reserve has indicated it is in no hurry to lower rates, which has contributed to the Canadian dollar's slump to its lowest levels since early 2016 against the US dollar. Based on preliminary data for November, Canada's housing market is wrapping up the fall season on a stronger note, according to RBC economist Robert Hogue. He attributes this positive trend to lower interest rates and the possibility of further cuts in the upcoming year, which are turning pent-up demand into active home buying. We expect the upswing to continue into 2025 as interest rates fall further, Hogue said. Hogue noted that market activity is markedly higher than the historic lows experienced last year, with the exception of Calgary, which already showed strong momentum in 2023. He anticipates that this recovery will persist into 2025, particularly as affordability improves due to declining interest rates. The economist points out that the increased housing inventory this year has played a significant role in enhancing the market's performance during the fall. The additional supply has provided buyers with more options and stimulated resale activity, but Hogue stressed that the current inventory levels indicate progress toward healthier market conditions. In the Toronto area, Hogue observed that the recovery gained additional momentum in November, with resales rising by 1.9% from October on a seasonally adjusted basis. This follows a strong 12% increase in the previous month. While affordability remains a significant issue in the region, falling interest rates seem to have encouraged some buyers to re-enter the market. In Montreal, Hogue described the market performance in November as a clear indication of rapid recovery. Home resales surged approximately 15% month over month on a seasonally adjusted basis, nearly returning to pre-pandemic levels. This occurred even as fewer sellers listed their homes, keeping inventories stable. The lower interest rates are driving demand, which Hogue mentioned is pushing up prices. The median price of single-family homes increased by 11% to $600,000, while condo prices rose by 8% to $425,000. However, Hogue cautioned that poor affordability might limit the pace of growth in the coming months. Hogue also identified signs of recovery in Vancouver, where resales rose by 1% in November following a sharp 20% increase in October. While property values have stayed relatively flat throughout 2024, the economist expects modest price increases moving forward, especially in the detached home segment, which faces tighter supply-demand conditions. He added that the MLS Home Price Index for Vancouver was down just 0.9% year-over-year in November, indicating overall price stability. Calgary continued to show robust activity, with resales climbing 4% in November and standing 50% above pre-pandemic levels. Hogue attributed this strength to high demand relative to supply, though he notes that the city's booming home-building activity is helping to replenish inventories. This has eased upward pressure on prices, with the composite MLS Home Price Index increasing by 3.5% year-over-year in November, a slower rate than earlier in 2024. Hogue expects this surge in construction to help moderate price growth in the coming year. The path to recovery looks promising, but affordability will remain a critical factor influencing market dynamics in the near future, Hogue said. As we continue our exploration of the Canadian real estate landscape, let's turn our attention to some recent research on housing affordability indicators and targets. The Canada Mortgage and Housing Corporation, or CMHC, has been closely examining the state of housing affordability across the country, especially in light of the changes brought about by the COVID-19 pandemic. According to Mathieu Laberge, the chief economist and senior vice president of housing economics and insights at CMHC, the pandemic created a ripple effect that made housing unaffordability contagious. This phenomenon was particularly evident as the supply and demand imbalances in larger markets like Vancouver and Toronto began to spread across Canada, affecting affordability nationwide. In their latest research, CMHC suggests that Canada should aim to return to pre-pandemic levels of housing affordability for most regions. However, Laberge emphasizes the need for more comprehensive solutions for the major urban centers of Toronto and Vancouver. These cities face unique challenges due to their size and the intensity of their housing markets, necessitating targeted strategies to address affordability issues effectively. The report highlights that achieving these targets would involve a multifaceted approach, combining policy changes, increased housing supply, and innovative financing solutions. By focusing on these areas, CMHC believes it is possible to alleviate some of the pressures that have been building up in the housing market over the past few years. The full article detailing CMHC's findings and recommendations is available on their website. For those interested in a deeper dive into their research, it provides valuable insights into the current state of housing affordability and the steps necessary to improve it moving forward. As we wrap up today's episode, it's clear that addressing housing affordability remains a critical issue for Canadians. With the right strategies and concerted efforts, there is hope that we can move towards more affordable housing solutions across the country.